Toronto is the epicenter of problems. The BC is in not good shape at all, and potentially will get worse. BC just might be a year and a half behind Toronto in the problems. So the essence of it is a dysfunctional housing market, and particularly a complete madhouse when it comes to new construction costs.
Canada's housing market is imploding. Benchmark prices are down 20% from their 2022 peak. 900,000 homeowners are staring down a mortgage renewal cliff. In 2026, this is not a correction. This is not a soft landing. Economists are calling it the steepest housing downturn since the early 1990s, and the worst of it may not even be here yet. For 2 decades, Canadians were told the same thing. Property values only go up. Buy now or be priced out. Forever. And for a while, that story held. Prices in some cities climbed over 300%. The whole economy started to organize itself around that single fragile premise. But there was always a number that told a different story. Canada's housing stock ballooned to 3.1 times the entire GDP of the country. Think about what that means. The homes Canadians live in became worth more than 3 years of everything the entire nation produces. The International Monetary Fund flagged Canada in 2023 as carrying the highest mortgage default risk of any advanced economy on Earth. The IMF. Not a fringe analyst, not a disgruntled blogger. The IMF. The vulnerability was structural. It was baked in. Every warning sign was visible to anyone willing to look. And the people who should have acted, the regulators, the policymakers, the bank executives, looked the other way because the music was still playing and nobody wanted to be the one to sit down. Now the music has stopped, and what comes next is going to redefine what Canadians thought they knew about wealth, about security, and about the price of ignoring inconvenient truths. Let's be precise about what happened at the peak. In early 2022, Canadian benchmark home prices hit levels that had no historical precedent and no rational justification. Then they fell, over 20% nationally from that peak. And when you adjust for inflation, when you account for what that money actually buys, the real losses climb to approximately 30%. In Toronto and Vancouver, prices reached 15 times the average household income. 15 times. The accepted international standard for an affordable housing market is a price-to-income ratio of around 3. Canada blew past that years ago and kept accelerating. Now consider the debt side of this equation. Canadian household debt now sits at 107% of GDP. 107%. Before the 2008 financial crisis, the one that nearly collapsed the global economy, American household debt peaked at around 98% of GDP. Canada is sitting 9 points higher than the United States was at its most dangerous moment. Let that sit with you for a moment. The people who built their retirement around home equity, the young families who stretched every dollar to get into the market at the top, the investors who leveraged one property to buy 3 more. They are all now living inside a number that keeps moving in the wrong direction. And the rate hikes that triggered this collapse, that story is far more deliberate than most people realize. The Bank of Canada did not stumble into this crisis. It engineered the conditions for it, then tried to claw its way back out. During the pandemic, the bank dropped its overnight rate to 0.25%. That was March 2020. They held it there for nearly 2 years, pouring fuel onto a housing market that was already running dangerously hot. Canadians were told borrowing had never been cheaper. They believed it. They borrowed accordingly. Then everything changed. Between March 2022 and July 2023, the Bank of Canada raised rates 10 consecutive times. 10 times. The overnight rate went from 0.25% to 5%. That is a 475 basis point swing in roughly 16 months. But the single most shocking moment came in July 2022, when the bank announced a 100 basis point hike in a single meeting, 1 full percentage point at once, the largest single meeting increase in decades. Governor Tiff Macklem stood before cameras and acknowledged that Canadians were being, in his words, really squeezed. That was his phrase, really squeezed, as if the institution he commanded had nothing to do with the squeezing. Variable rate mortgage holders absorbed the pain immediately. No buffer, no delay. Their payments adjusted in real time as the rate climbed. And these were not marginal borrowers. These were ordinary Canadians who took out mortgages during a period when the bank itself was projecting rates would stay low. Here is what makes this particularly damning. Canadian household debt relative to income was already among the highest in the developed world before a single hike landed. The bank walked into that room, looked at those debt levels, and raised rates anyway. Aggressively, repeatedly. They knew what they were hitting. And the mortgage renewal wave they set in motion, that is the next disaster, and it is already here. 900,000 Canadian homeowners are staring down mortgage renewals in 2026. Let that number settle for a moment. 900,000 families. These are people who locked in mortgages in 2021 when the Bank of Canada had rates pinned near the floor. The average 5-year fixed rate that year was sitting between 1.5 and 1.9%. Historically low, genuinely extraordinary. And for a brief period, it felt like good fortune. It was a trap. Those contracts are expiring now. And the rates waiting on the other side are not 1.5%. They are not 1.9%. Today's renewal rates are sitting in the 4.5% to 5.5% range. For a homeowner who bought at peak prices with a mortgage locked at 1.7%, the monthly payment shock on renewal can run into hundreds or even thousands of dollars per month. On the same house, same debt, radically different payment. Canada's stress test makes the trap even more brutal. To qualify for a new mortgage, borrowers must prove they can handle payments at their contract rate, plus 2 percentage points. When the contract rate itself is already above 4%, that stress test threshold climbs above 6%. Many of these homeowners cannot pass it. They cannot refinance. They cannot renegotiate on favorable terms. They are locked in. And selling is not the escape hatch it once was. Values in many markets have already dropped 20% or more from the 2022 peak. Selling now means absorbing that loss in cash. For homeowners who stretch to buy at the top, selling might not even cover the outstanding mortgage balance. They cannot stay. They cannot leave. They are trapped between a payment they cannot afford and a sale price that would bankrupt them. 900,000 of them. Renewals coming due. The clock is already running. And in the Greater Toronto Area, the consequences of that trap are no longer theoretical. The numbers coming out of the Greater Toronto Area are not a warning. They are a verdict. In the first 8 months of 2025 alone, 232 power of sale listings hit the GTA market. Power of sale is the Canadian legal mechanism by which lenders seize and sell properties when borrowers default. 1,232 of them in 8 months. That is more homes seized in 8 months than in all of 2024 combined. Read that again. More in 8 months than in the entire previous year. The city of Brampton is where the pressure is most visible. Brampton's mortgage delinquency rate has climbed tenfold since 2019. It now sits at 0.6%. That sounds like a small number until you understand what tenfold growth in delinquency represents in human terms. families losing homes, investors underwater, speculators wiped out. And Brampton is not an outlier. It is a preview. At the national level, Canada's mortgage delinquency rate hit 0.26% in the fourth quarter of 2025. Economists and credit analysts tracking this data are describing the speed of that increase as the fastest recorded rise in 30 years. 30 years of data, and nothing has climbed this fast. This is not a slow deterioration. This is an acceleration, the kind that does not reverse quietly. The foreclosure wave rolling through the GTA right now is the direct consequence of everything that came before. The rate hikes, the debt levels, the renewal cliff. It is all converging in a single, brutal moment. And the banks funding those mortgages, they have been watching this build. And now the warnings from the institutions who were supposed to see this coming are impossible to ignore. RBC is not a fringe blog. It is the largest bank in Canada. And in its fourth quarter 2023 report, RBC declared that housing affordability had reached the worst level ever recorded in the bank's history of tracking it. Not the worst in a decade, not the worst since the financial crisis, the worst ever. Full stop. Let that sit with you for a moment. The International Monetary Fund did not wait for the dust to settle either. In May 2023, the IMF issued a direct warning. Canada carries the highest mortgage default risk of any country it monitors globally. Not among the top 10, not regionally notable. First place, globally, for the wrong reasons. And then CMHC, the Canada Mortgage and Housing Corporation, echoed that same warning in its own housing market outlook. The institution that exists specifically to backstop Canadian housing told Canadians that the risks the IMF identified were real, present, and accelerating. Think about what that means. The bank, the international body, and the Federal Housing Agency all arrived at the same conclusion independently. That is not coincidence. That is convergence. That is what happens when a crisis stops being theoretical. On the ground, in the Greater Toronto Area, listings are now sitting unsold for 90 to 180 days or longer. Properties that would have sold in 48 hours during 2021 are collecting dust. And sellers are not holding firm. They are getting out. Not because they want to, because they are afraid that if they wait, the number they can get today will look generous compared to what they will be offered 6 months from now. That fear is not irrational. That fear is data-driven, and the data keeps getting worse. The Canadian Real Estate Association does not use words like crash. It is not in their interest to do so. But when CRE officially downgraded its home sales and price forecasts for 2026, the message underneath the careful language was unmistakable. The projected 5.1% sales increase they are now pointing to is not a recovery. It is damage control. It is the organization managing expectations downward while trying not to trigger the panic that the underlying numbers already justify. First-time buyers are caught in a trap that has no clean exit. The inventory that exists is priced beyond what their incomes can support. The inventory that would be affordable does not exist in the quantities needed. They are squeezed from both directions simultaneously. Too little supply at the bottom, too much price pressure everywhere else. Mortgage strategist Ron Butler has been one of the clearest voices on where this ends. His assessment is not optimistic. Prices could stay flat for 3 years with no meaningful rebound. Not a sharp crash followed by recovery. A slow grinding plateau that erodes real value year after year, while mortgage costs remain elevated and carrying costs continue to punish anyone holding property. The analyst consensus is shifting. The word correction, which dominated the conversation in 2022 and 2023, is being quietly retired. What is replacing it is more serious. Structural crash. A reset not driven by a temporary shock, but by the fundamental mismatch between what Canadian housing costs and what Canadian incomes can actually bear. CREA downgrading its own forecast is not a footnote. It is an institution admitting that what it told you last year was too optimistic, and that admission should make you ask what this year's forecast is still getting wrong. As if the mortgage renewal cliff and the affordability collapse were not enough, Canada is now absorbing two additional shocks that are hitting the housing market from completely different directions at the same time. The first is the trade war. Stephen Poloz, the former governor of the Bank of Canada, has put a number on what American tariffs could cost this country: 2% of GDP. That is not a rounding error. That is a structural wound to an economy that was already under severe pressure. Jacques Shaw, one of Canada's leading economic voices, has said plainly that Canada is facing economic challenges not seen in decades. Decades. The second shock is quieter, but potentially more corrosive over time. Artificial intelligence is beginning to displace the kinds of white-collar, knowledge economy jobs that have historically supported the income base behind Canadian mortgages. The people who bought in Toronto and Vancouver at peak prices were not factory workers. They were professionals. And that professional class is now facing an employment landscape that is shifting faster than any previous generation has had to navigate. Rising unemployment erodes the income base. A weaker income base means more borrowers under stress. More borrowers under stress means more forced sales. More forced sales mean more downward price pressure. And here is what makes this moment genuinely different from every previous housing scare in Canada. The trade war uncertainty and the AI displacement pressure are freezing both buyers and lenders at the same time. Buyers will not commit. Lenders are tightening. When both sides of the transaction go cold simultaneously, markets do not correct gradually, they seize. And what is coming next for the banks that hold all of this exposure is a story that demands its own reckoning. Calkeen Media reported in 2026 that Canadian bank stocks were being shaken to their foundations by the real estate downturn. Not rattled, not pressured, shaken. BMO research has since been cited as direct evidence of systemic market deterioration, the kind of internal acknowledgement that does not come from an institution unless the numbers have already turned alarming. Here is the figure that should stop you cold. Canadian housing stock sits at 3.1 times GDP, 3.1. That is not a sector. That is the entire financial architecture of the country, leveraged against a market that is now moving in the wrong direction. When exposure reaches that level, the word systemic is not hyperbole. It is a clinical description of what happens when one sector pulls everything else down with it. Mortgage delinquency rates are accelerating, not ticking upward. Accelerating. Every missed payment lands on a lender's balance sheet. Every power of sale that closes below the original mortgage value is a loss that must be absorbed somewhere. The banks absorbed the risk when they wrote those loans. They are absorbing the consequences now. Think about what that means for the institutions Canadians trust with their savings, their mortgages, their retirement accounts. The same banks that financed the bubble are now sitting inside it as it contracts. They cannot exit. They cannot hedge their way out of 3.1 times GDP in exposure. They are in it, fully, and the market is moving against them every single month. The financial sector cannot escape what the housing sector started. That is not opinion. That is the arithmetic of interconnected balance sheets in a country where real estate is not just an asset class. It is the asset class. And when BMO researchers and Calkeen analysts are both pointing at the same deterioration from different vantage points, that is not coincidence. That is confirmation. Every structural warning that economists, analysts, and institutions spent years issuing has now stopped being a forecast and started being a headline. Thousands of Canadian homeowners are trapped inside mortgages they cannot service, inside properties they cannot sell, with no exit available that does not cost them years of financial recovery. The next 12 months will determine how deep this damage actually goes and whether Canada's financial system, tested like it has not been tested in a generation, holds together or begins to fracture in ways that will reshape this country's economy for decades. The reckoning is not approaching anymore. It is here, and it is only getting started. Subscribe now and hit the bell. This crisis is accelerating, and new data on the mortgage renewal cliff breaks every single week. Every update matters. You need to be here when it does.
Toronto is the epicenter of problems. The BC is in not good shape at all, and potentially will get worse. BC just might be a year and a half behind Toronto in the problems. So the essence of it is a dysfunctional housing market, and particularly a complete madhouse when it comes to new construction contracts. Toronto is the epicenter of problems. The BC is in not good shape at all, and potentially will get worse. BC just might be a year and a half behind Toronto in the problems. So the essence of it is a dysfunctional housing market, and particularly a complete madhouse when it comes to new construction contracts. Toronto is the epicenter of problems. The BC is in not good shape at all, and potentially will get worse. BC just might be a year and a half behind Toronto in the problems. So the essence of it is a dysfunctional housing market, and particularly a complete madhouse when it comes to new construction contracts. Toronto is the epicenter of problems. The BC is in not good shape at all, and potentially will get worse. BC just might be a year and a half behind Toronto in the problems. So the essence of it is a dysfunctional housing market, and particularly a complete madhouse when it comes to new construction contracts.